Hi, and under managing personal finance, today we're going to be discussing introduction to financial statements. Now, you all know in our last video series which we have done, we gave an introduction to accounting. So you identified accounting is a means of classification, analysis, and recording of financial information so that it can be used by the stakeholders, users. So what we do in this particular video series is that we will identify the final product of the accounting function, that is the financial statements. So one by one, step by step, we will go and we will discuss how it works. So after this, what are the learning outcomes that will be in your mind? So you will be able to define key accounting terminologies like assets, capital, liabilities, income, expenditure, which we have done, and you will be learning it once again here as a refresher. And you will be able to define what's the difference between cash and profits. And you will be able to prepare a basic set of financial statements, an income statement as well as a balance sheet, the statement of financial position. And likewise, you will be able to analyze financial statements, vertical and horizontal trend analysis, ratio analysis, you will be able to do. So from this particular series, we are moving into the practical aspects of accounting, practical aspects of financial record keeping. So we will first look at how modern accounting has evolved. Now you know accounting has evolved from the industrial revolution stage. So UK, England has helped the accounting to be evolved, developed to a greater distance. Now we will see accounting as a profession goes under a framework. Accounting as a profession goes under a framework. So whatever in accounting, financial record keeping that we are doing should be done under that particular framework. This framework is known as accounting standards. So accounting standards are a set of principles or policies that governs the accounting profession. Standards are a set of policies or set of uh, principles that governs the accounting profession. So accounting standards say what we have to do to recording a particular transaction. The standard says what we have to do. So the accountants cannot contravene the standards. Standards have to be always preserved. Standards have to be always abided by. There are very important accounting standards, widespread accounting standards that are in the profession of accounting. One is known as, your first bullet point is International Financial Reporting Standards. We call it IFRS, International Financial Reporting Standards, International Accounting Standards, IFRS. And also your third bullet point in the slide, it's International GAAP. GAAP means Generally Accepted Accounting Policies. International GAAP, Generally Accepted Accounting Policies. So once again, accounting as a profession goes under a framework. So the framework is known as accounting standards. The standards say what the accountants have to do to a particular transaction recording. So accountants cannot violate the standards. Some examples for standards are US GAAP, Generally Accepted Accounting Policies, or International Financial Reporting Standards, introduced by International Accounting Standards Committee. So all these standards were introduced due to some corporate scandals, like we will learn them later. Enron scandal, last point, Enron scandal, Parmalat scandal, Satyam scandal, Olympus scandal in Japan. Likewise, where accounting transactions were reported in an incorrect manner. So once again, accountants have to go with the standards, IFRS or IAS. Now, this international financial reporting standards, which we discussed earlier, are introduced by International Accounting Standards Board, IASB, located in London. So they give the framework for companies to maintain their accounts according to that particular IFRS framework. So one type of accounting standards is IFRS, which is International Financial Reporting Standards, and the other one, GAAP, Generally Accepted Accounting Policies. So based on both IFRS and GAAP, we have to maintain our financial accounts. So accounting principles, there are elements. Objective of accounting principles is financial performance and position. So there are some assumptions which are going concern, accrued concept, understandability, right? So we will discuss this. So accounting principles, accounting policies, accounting standards, we call all these as accounting framework within which the accountancy profession has to work. Accounting framework within which the accounting profession has to work. So accounting principles take all accounting standards as policies as well, the entire larger picture, the framework, accounting framework. It has an objective of financial performance and position recording. In last slide, in last topic, we have discussed financial position, statement of financial position, and performance will be evaluated by the income statement. So objective of these accounting principles is to develop the statement of financial position and then the performance, the income statement. Then these accounting principles are discussing two principles. One is going concern principle and the other one the accrued principle. Now we will discuss the going concern principle. Going concern means accounting makes records assuming that organization will be surviving for the foreseeable future. Accountants prepare accounts, financial statements under going concern assumption, assuming that organization will be surviving for the foreseeable future. That means accountants believe that expect or assume that the organization will be in existence for a period of more than 1 year. That is going concern principle. Organization will be surviving for a period of more than 1 year. That's why, students, we divide our assets and liabilities as, can you remember, current and non-current, where current liabilities are liabilities that you have to settle within 1 year. Non-current means liabilities which you have to settle more than 1 year. So going concern assumption is that accountants assume that the business will be in operation for a period of more than 1 year and record the transaction accordingly. So items which are settling within 1 year will be current and after 1 year will be non-current. Then accrued concept. Accrued concept means you will not recognize the cash transaction only. but you will take the entire payable amount. Now let's assume for a particular financial year, now we are discussing the accrual concept. For a particular financial year, assume electricity bill for a particular month, right? Take a month. For a particular month, the electricity bill is 100 pounds. Electricity bill is 100 pounds. But you have only paid out of that 80 pounds during that particular month. Electricity bill is 100 pounds, but you paid only 80 pounds. Now, accrual basis means you will record the entire 100, not the cash paid amount of 80 pounds. You will record the entire thing. That is the accrual principle. Regardless of whether money is paid or not, accountants will record the entire transaction value pertaining to that particular period. So it will be the entire amount, not the cash amount. So accrual basis is something different from the cash basis where you will record the entire amount. So going concern, the earlier concept, it is the accountants prepare financial statements assuming that the business will be in operation for foreseeable future. So assets and liabilities will be current and non-current, and accrual means whether cash paid or not will be recorded for the entire financial year. And financial statements should have some qualitative aspects as well. They should be understandable, they should be relevant, they should be reliable, and they should be comparable as well. So financial statements have some elements which we have discussed earlier: assets, liability, equity, income, and expenditure. So other side, just read, that's enough. So now we will see, when someone says a set of financial statements, what constitute a set of financial statements? Generally, a set of financial statements, the final accounts, in other words, set of financial statements will include these following 5 components. All these are individual statements. So looking at them, the users and the stakeholders of financial statements make their own business decisions. Number one, first one, it is known as statement of financial position. Generally we call it the balance sheet. Statement of financial position. The second one, statement of comprehensive income. Financial position will show the assets, liability, equity figure on a particular day, and the statement of comprehensive income will show the amount of profits earned per day, earned per annum. And the statement of changes in equity, which shows by which amounts the owner's capital equity has changed during the year. And the statement of cash flow, which shows the cash moving in, the cash going out, and the final cash balance of the business. Cash flow. And the last one, explanatory notes to the accounts. How accounts are described. The notes are there to explain the accounts. So these 5 components will comprise the set of financial statements. Number one, statement of financial position, statement of comprehensive income, statement of changes in equity, cash flow statement, and explanatory notes to the accounts. Good. Now we will look at a question, a simple question. Now, generally when you are speaking, when you go through these finance related articles, you will come across that there is a saying, financial statements are required to show a true and fair view. So what does that mean? Financial statements should show a true and fair view of the business's operations. True and fair. The accounts should show a true and fair view of the company's affairs. So what does that mean? Let's see. Now, those two words, true and fair. We will take the first one. True means financial statements should show a true picture of the business. That means it should be factually correct. Now, facts wise, the financial statements should be correct, factually. So, they should not include anything that is incorrect. So, the calculations in the financial statement should be correct, the double entry should be correct. So, financial statements should be factually correct. That is meant by being true, being factually correct. And the other one, financial statement should be fair, should have a fair view of the business. So what is this fair view? Fair view means financial statements should be unbiased, should not be biased towards anyone. Financial statements should not be biased towards the operations of the management, should not be biased towards the shareholders, should not be biased to employees, should be fair, objective financial statements. So, true and fair view means, true means financial statements should be factually correct, and fair view means financial statements should be having unbiasedness and being fair, not biased towards anyone. So that's meant by being having a true and fair view. So that true and fair view explained further was it? We will go point by point. Financial statements, as we discussed, prepared using appropriate accounting policies, and those policies are consistently applied towards year from year. Accounting policies consistently applied, true and fair, and prepared according to legislation and applicable accounting standards. And any departure explained fully, adequate disclosures are done, and financial statements are not misleading, factually correct. So true and fair view means that. That means factually correct and it is unbiased, prepared in accordance with legislation, the policies, accounting policies, everything explained properly and not misleading.